Hello, everybody, and welcome back. My guest today is Michelle Lopez. Michelle is a portfolio manager and head of Australian Equity from Aberdeen Standard Investments. Welcome, Michelle.
Thank you. Good to be with you today.
Thank you, Michelle. So, Michelle, the Australian economy has been hit hard by COVID-19, and we know that especially Australia is heavily relying on commodity. So, how did the pandemic influence Australian stock market so far?
Yes, you're right. The commodities is a big part of our market. So to put some context to that, it represents about 20% of our index. And we have some very large miners within that, which are BHP and Rio Tinto, which together represent 10% of the index. So you need to, I guess, take a step back and understand the key drivers of both those stocks. And that's predominantly iron ore. Iron ore, when you think about the key customer, it's China. So China buys 70% of all seaborne iron ore. So we've really needed to look at China and the activity, the economic activity coming from that. As we know, COVID originated and started in China, so they were the first ones in, but they were also the first ones out. And what we've seen is that demand of iron ore has actually remained very stable over this period. So that's the demand situation. The supply has also been quite positive. You think about the largest nations being Australia and Brazil. Brazil is currently in a situation that COVID and the virus is a real hotspot. So they're shutting down operations. So that means there's been a real tightness in supply. So those two, the supply-demand balance has certainly been there, and it's supported prices within iron ore. So you could say actually that commodities have been relatively resilient over this period. The only exception is the base metals, so the likes of copper. And copper is what we consider a bellwether for global economic growth. And as such, that's been a lot weaker. All the data that we're seeing coming out is that we are through the worst. So we have seen a recovery, and we expect a recovery in these names too.
So the unemployment rate is dramatically rising in Australia. How is the government reacting? What measures do they use to counter the situation?
You're right, it is rising very, very sharply. So it's expected to hit about 10%, and it's a peak, but it is likely to be a temporary peak. So simply put, the government is spending, and it's spending a lot. When you consider the strength of the government's financial position going into the crisis, it was relatively better placed than a number of developed markets. So government debt at the time was 43%, and this compares to over 100% in the US and likewise in the UK, and over 200% for Japan. The stimulus has been very much focused on job retention. So the biggest package that we've got here is called the Job Keeper, which is a wage subsidy, which enables people to remain employed while the lockdowns happened. As a proportion of GDP, it is very large. So we're looking at something like 8.7%. And what that effectively means is when activity returns, businesses can respond much quicker as they don't have to rehire for that.
So what consequences did COVID-19 have so far on valuation and prices of Australian stocks?
We've been through probably three phases over this year. We had the first part of the year, and it was relatively benign market activity until we sort of hit that point in mid-February where COVID was no longer a China problem, was actually a worldwide problem. And from that, we saw a very deep and aggressive correction in markets. So for us, we had about a 40% leg down, and then we saw a very sharp bounce back. And what we've seen from a valuation perspective and the rally that we've seen in equity markets more recently is that investors are increasingly expecting a V-shaped rather than a U-shaped recovery from an economic point of view. And that really seems at odds with what we're hearing from the management of the companies that we own, where their outlook remains very uncertain, and have really withdrawn guidance, which means that the earnings estimates in the market are quite stale. So from a valuation perspective, to your point, at a headline level, it looks quite full, but you do need to dig into the companies and the sectors to understand the shape and the duration of the COVID recovery, because it's not homogenous. We have some stocks that have seen very little impact from the virus, and other stocks that are actually exposed to trends that have been accelerated. So for us, valuations within those companies, and a number of these are healthcare names as well as technology companies, still remain on a long-term basis, because we do look at stocks taking a 3-year view, look reasonable. However, on the flip side, there are companies that we feel valuations are no longer sustainable at these levels. Banks, which you saw financials make up a very large part of our market, they're still trading relatively cheap. So they're trading well below book values, which are levels that we haven't seen since the GFC. So over near term, they look quite attractive, although there are sort of longer term structural challenges that the banks are facing.
What does this mean for your portfolio? How did you act since the outbreak of COVID-19? What changes did you make to your portfolio strategy?
Yeah, I think a really important thing to note is a key consideration for us and part of our investment process has always been balance sheets. And little did we know how important that was going to be in the current environment. So for me, this is actually a time where active managers such as ASI can really prove their worth. So for us, what that meant was constant engagement with the companies that we're invested in. So meetings with management and really asking how they've adapted to these new difficult conditions. It also meant an inordinate amount of time spent on the analysis of balance sheets, cash flows, business models. So this did lead to a number of portfolio adjustments, but most importantly, though, there was no deviation away from our very disciplined process, which is all around high quality companies and investing those. So, for instance, in late Jan, early Feb, we started to reduce our exposure to companies that were in the travel industry, so the likes of Auckland International Airport, and we started adding to positions that were much more defensive, that had a much more sort of resilient cash flow profile, and also gold. And we did that not that we had any foresight as to how this would play out, but we felt that the level of volatility in our market was only going to go up. When we experienced a very sharp correction throughout March, we started to very selectively add to those positions that we already owned in most cases, but we felt had overshot to the downside, and importantly had very strong balance sheets still. We supported a number of our companies, the ones that raised capital in particular, and we also let a number of our outperforming stocks run. And we did that because they were exposed to trends or businesses that were actually benefiting from the virus. So an example here would be Fisher & Paykel Healthcare, which manufacture ventilation masks, which were obviously incredibly high demand for COVID patients that were hospitalised. I guess the most important thing now is how we're positioned looking forward, and really it's a tricky one because there's a very wide range of outcomes that are possible here, and I tend to consider sort of three three broad exposures. And if I think about it in buckets, the first are those companies that we call defensives. So, we own them because we can't rule out a second wave of COVID-19 or a deep recession scenario. So we've maintained a position to these high quality defensive cash generative names where the outcome of earnings is quite small. The second bucket is all around those companies leverage to the reopening of economies. So the likes of travel, education, gaming, such as Aristocrat. And then the third bucket are those companies that have long-term structural growth drivers within them, and that's the main part of the portfolio as well. So ones where, companies that are benefiting from the long-term consequence, a number of healthcare names, and also a number of tech names that are I guess, benefiting from that migration to online and cloud. But we remain absolutely committed to quality companies, and this has really come through in the characteristics of our fund. So if you look at those, our portfolio of companies have higher margins, higher return on both assets and equity, stronger balance sheets than the broader market itself.
I'm totally aware that predictions are currently really hard, but what is your outlook for 2020, 2021 for Australian stocks?
It's gosh, I wish I could sit here very confidently and provide a clear answer. At this point, it's very difficult to know where we will be in 12 months' time. I'm perhaps more optimistic today than I was 2 months ago, and I say that because we now have further information around the impact that the virus has had. We're now moving into what I call phase 2, which is the reopening of economies, and we're actually starting to see some positive data off the lows of April across the globe. Having said that, though, I feel the market has obviously moved ahead of what the data. So from here, what takes the market on another leg up is highly uncertain still, because as these stimulus packages get lifted, if they can get lifted, that is, we're going to see the real impact that the virus has had on businesses and on the consumer. So I'm still cautious around the outlook, particularly given the strong, the 30% rally that we've seen in the equity market here. Longer term, however, I'm actually quite favourable and quite constructive on the Australian market for a number of reasons. Firstly, which we've just touched on, I think we're going to come out of this quicker than many other countries. We've certainly supported businesses, and our banks have been given an open mandate by the regulator to do that. So there's limited solvency issues there. Secondly, we've got some world-class companies. If I consider healthcare, we've got 3 or 4 stocks in our portfolio that are really industry leaders globally. So the likes of CSL, Cochlear, Fisher & Paykel Healthcare. Likewise, within sort of technology, there's some real key companies within our market that have got very strong and long runways for growth. And then, of course, we've got, I guess, our proximity to China as well, and we know that China, from a growth perspective, are really looking at shifting away from more the manufacturing side to IP. So again, and that consumption story that we're seeing play out in China, we're very well placed to be part of that.
This was Michelle Lopez, Head of Australian Equity at Aberdeen Standard Investments. Thank you very much, Michelle, for being here with us and sharing your views.
Thank you very much, and please take care.